I don't want to go to old history, just to underline perhaps something you have, why we like bonds. I come from the fixed income side, so I have a good reason to like bonds, is because I think investors and especially our end clients continue to not understand that the return that you will achieve on bonds, it's not the yield to maturity that you see on the bonds. It's higher than that. And they perceive the risk of the bonds much higher than the reality. And the best proof is here. Well, what I did is very easy. I took the GGB. GGB is the Japanese government bonds. Over the last 5 to 10 years, the yield on GGB has been between 0 and 1. Okay? So very little to expect in terms of returns. And I have taken, in comparison, the MSCI World in local currency. So I have been very fair to take the MSCI World and done the Japanese market. But, okay. And what I do, it's not the total return. I did the risk-adjusted return of GGBs yielding close to nothing versus MSCI World that has done quite well over the last few years. Volatility, but good performances. The blue line is the rolling 3-year Sharpe ratio of GGBs. The gray line is the equity market. So it's true from time to time, equity is better investment than bonds. But look recently, bonds have a better risk-adjusted return than the equity. And another proof I can give you of, I don't think that we are all stupid, and especially Japanese investors, why they should be more stupid than us. You have here 2 lines. The gray line represents the dividend yield of the equity market without the financial, because we all know that dividend yield for financial is difficult to assess, not a lot of sustainability, visibility. And the blue line represents the yield to maturity of corporate bonds in Europe without the financial. So when you look at that, you say, Fabrizio, you are stupid. Why you are buying bonds? They are yielding 0.7. So the best you can do over the next 5 to 10 years, assuming rates don't move, it's 0.7. You buy equities. If equities don't move, you do 3% of dividend yield. And perhaps even equities can go much higher. And the fact is, again, I am not speaking only about returns. I am speaking about the certainty of doing these returns. And with bonds, I am almost certain to do this very poor 0.7, while with equities, yes, you have 3% dividend yield. But when your equity loses 10% in 1 week, you have lost already 3 years of your dividend yield. So it's not a screaming boy. And the proof that it's not a screaming boy, you know what? Is Japan. Same graph for Japan. Look at the trend. It's getting wider and wider, not smaller and smaller. You have, on the topics, you have 2% dividend yield compared to 0 on the corporate bonds market. So why Japanese investors are buying bonds? They are very stupid guys. No, it's because they know that in Sharpe ratio term, it's not so bad. It's difficult to believe, but here is the truth. Is the truth. And I think that this situation will continue as long as we remain in this kind of low growth, low inflation, very accommodative monetary policy. And to some extent, it reflects the Fed model. You remember the Fed model? You compare equity yields with bonds yields. So equity yields is just the inverse of the P. So if, to make it simple, if you have a market, equity market with a P of 20, it makes an earnings yield of 5%. Okay? And you compare that to the bond yields. So here I have taken in Europe compared to German bonds, Italian BTP, and in the US compared to the Treasury, compared to the corporate bonds market. And usually this model was quite simple. It was the model of the Fed, the model of Bernanke, saying when you are here, it means either that bonds are very expensive to equity, or, is the same phrase, equities are cheap compared to bonds. yes, you have some fluctuation, but it's now 16 years and still counting that bonds are more expensive than equity, or that equity seems cheap compared to bonds. And it may continue, it may continue, it may continue. And that is the case because on one side, you have the uncertainties of potentially very high return, which are equities, but the bonds are now the very high price of safety in a world that is getting more and more complicated. So it's not that the market or investors are stupid, it's just the reflection of the current situation we are facing. I will stop here. I think the end game of that will be one day kind of helicopter money, but real helicopter money, when we give money to the people, not money to some sectors decided by the state, but really freely into the economy. At some point, that will really push inflation higher, and that will also help to reduce the inequalities between that has created most of the quantitative easing and most of the current monetary policies.